Thank you for tuning in. I am your host, Joseph Martin. Hit that like and subscribe button to support the channel and hit that bell icon to receive notifications. Today, we are going to discuss shadowing portfolios. But before we do, let's go to our disclaimer. The content in this video is for educational and entertainment purposes only. I am not a licensed financial advisor, and nothing shared here should be considered financial advice. Always conduct your own research and consult with a licensed financial professional before making any investment decisions. All securities, trades, and positions shown are for demonstration purposes only. Investing involves risk, and any financial decisions you make are solely your responsibility. If you want to get paid like a professional, you need to operate like a professional. And professionals understand the mechanics and history of things they expect to make money from. Quick history lesson. Something that's rarely mentioned about the stock market crash of 1929 is that the regulations that they had in place prior to the crash were a joke. It was full of loopholes that put the majority of the public at a disadvantage from everything to information, misinformation, schemes, you name it. I believe part of the reason they don't mention this is because they don't want you to realize how much politics plays a role in laws and regulations, especially in areas dealing with money, because you might wake up and educate yourself so you can understand what's really going on. In the roaring 20s, the years leading up to the crash, the whole country was experiencing FOMO, the fear of missing out. I plan to do a whole video explaining FOMO, and I'll put a link for it up on the screen. It was easy to fall victim to it because you could pick a stock with your eyes closed. I mean, you could just guess and make money. Everybody was making profits in the market, even those who had no idea what they were doing. This caused the market caps of these companies to become extremely overvalued. Some companies were trading at 8 or even 10 times their fair value. To put this in perspective, let's say a company was worth $1 million. That company's stock would be trading on the market as if it was worth $8 or $10 million. If that wasn't bad enough, not only was the inexperienced general public investing heavily in the stock market, but they were also investing with borrowed money, money that they borrowed from their brokers and banks. And those brokers and banks were also using borrowed money to loan out and to invest in the stock market themselves. Everybody, the institutions, the public alike, were making money hand over fist. The public was also allowed to use 10-to-1 leverage, which meant they could purchase $100 worth of stocks for $10. The problem is, if these stocks lost more than $10 worth of value, you lose all your money and some of the money you borrowed. If the majority of the market is doing this, banks, businesses, institutions, and the general public, it was essentially being built up on valuations made out of a house of cards. Politicians want the public to believe that the crash of 1929 came out of nowhere. Nobody saw it coming, when basic math could have told you that those market conditions were not sustainable. But they want the event to be remembered as something that couldn't have been avoided and that everyone lost everything, which isn't true. Far from the truth, in fact. A lot of families built and grew their fortunes during the crash of 1929, and the Kennedys were one of those families. President John F. Kennedy's father made a fortune in the stock market crash of 1929, betting that the previous leading stocks in the market would fall and fall fast. This is one of the biggest misconceptions the public has about the stock market, because the majority of them don't realize that you can make money when stock prices go down. John Steele Gordon, historian and author of An Empire of Wealth, said Joe Kennedy was one of the smartest people who ever operated on Wall Street. His morals weren't the best, perhaps, but his brain was. He wasn't a long-term investor. He was a profit-taking short-term trader who sold when he knew something he owned was highly desired. Everybody wanted, like they wanted bad. And when that happens, things are often overvalued. Joseph Kennedy made a fortune running pump and dump schemes in the market and participating in insider trading. Morally suspect, but perfectly legal at the time. This is a phrase that was used by the narrator in a documentary I watched about him to describe it. Here's an interesting thought. Most people only think of laws as preventing something from taking place, when the opposite is also true. There can be laws put into place that would allow something to happen, making it legal. But back to Joe. Joseph Kennedy supposedly was able to tell that the market was overvalued because when he was getting shoe shine, the shoe shine boy was giving him stock tips. If this is true, I believe he saw this as a red flag because people who don't invest are the hardest to convince to invest, especially people who would consider themselves laborers or working hard for a living. They wouldn't dare risk losing any money in the market, knowing how hard they work for it, unless they were under the impression they couldn't lose. This is why I believe Joe Kennedy would have seen this event as a clear indication that it was time to close all bullish positions and potentially start taking bear positions in the market. And that's exactly what he did. After the crash of 1929, our economy in the United States was in shambles, to say the least. Herbert Hoover was the president when the crash took place, and it occurred 8 months after he took office for his first and only term. What's crazy about this is the economic conditions that led to the collapse were rooted in the policies of the previous administration under President Calvin Coolidge, but he's rarely blamed for it. Since the crash didn't actually happen when he was in office, people usually only associate the collapse to President Herbert Hoover. So our 32nd president, Franklin Delano Roosevelt, was able to defeat President Herbert Hoover in a landslide. We only had 48 states at the time, and he won 42 of them. The public was convinced that the crash of 1929 was President Hoover's fault because it happened on his watch, and you couldn't tell them otherwise. If you take the time to study mass psychology, you'll find the larger the group sharing a collective thought or belief, the more irrational the group thinking becomes. President Roosevelt needed to get the country back on its feet economically. And part of the strategy for that plan was to put laws and regulations in place that would make the actions made by the banks, businesses, institutions, and insiders that led to the crash illegal. I don't know if you ever seen the movie Catch Me If You Can with Leonardo DiCaprio and Tom Hanks, but in that movie, spoiler alert, the FBI ends up using one of the best counterfeiters in the world to help them catch other counterfeiters. President Franklin D. Roosevelt, or FDR as they like to call him, started a new agency called the SEC, the Security and Exchange Commission. And he appointed Joseph Kennedy, a well-known, successful stock investor, right, with a reputation for exploiting loopholes in the system and profiting from unethical practices, to be its first chairman. The idea was, if anybody knew where the holes in the system would be, it would be someone who was known for going through them. Kennedy possessed a unique and unparalleled understanding of how Wall Street operated, and FDR knew this was invaluable. The goal was to restore the public's confidence in the stock market because it plays a major role in our economic system, not just here in America, but around the world. This move was as strategic as it was risky because of the concerns about Kennedy's ethics. FDR stood by his decision, saying, "Send a thief to catch a thief." Joseph Kennedy was wildly successful, reducing the amount of corruption and unethical practices that were previously being done as everyday business in the stock market. Insider trading is one of the most difficult forms of securities fraud to totally eliminate because it's one of the most difficult things to prove. Insider trading is using information or sharing information for financial gain that the general public doesn't have access to. It's legal for insiders to trade or invest in anything they want, true. And yes, they receive information before the general public has access. And sometimes the general public never has access to certain information. So how can you prove beyond a reasonable doubt that they weren't going to make those trades or investments anyway if they didn't have access to non-public information? Which finally brings us to our topic of discussion today. The best thing the SEC can really hope for when it comes to fighting insider trading is to make insiders' activities available to the public. So the SEC requires certain forms to be filed on the EDGAR database to do just that. And one of those forms is called the Form 13F. Who's required to file it? I'm glad you asked. Institutional investment managers, people like Warren Buffett, Cathie Wood, Paul Tudor Jones, Ray Dalio, George Soros, and Peter Lynch, for example. It's used to meet the requirements of regulations by the SEC to provide that transparency and maintain the public's trust in the market. This helps to level the playing field, so to speak, between insiders and the general public. This sounds good, but it's something that has to be filed every quarter, and the deadline for submitting it is 45 days after the end of the quarter. If you really understand the stock market, despite the prevailing theory that you can't time the market, timing is extremely important and possible. Once someone submits this form and is validated and accepted, it's usually available on the EDGAR database online immediately. But the problem is, if you wanted to attempt to shadow the trades and investments of someone filing the Form 13F, some of their trades could be up to 135 days old by the time you saw it. Now that you know this, if the trading and investment moves that these key people are making are so delayed, then how is it helpful? I believe it does provide transparency, but not timely enough to shadow their portfolios. And I'm about to show you why. So I've pulled up NVIDIA's chart using the Thinkorswim platform offered by Charles Schwab. And I'll put a link up on the screen for some tutorials if you want to learn how to navigate and use the platform. So what I want us to focus on is this grayed area that I placed on the chart. That is the time frame between the beginning of the quarter and the deadline. So that's 135 days. The beginning of this quarter that you see grayed out starts April 1st. And the deadline was August 14th. So what I want you to actually pay attention to, I'm going to mouse over this trend line so you can see what I'm talking about. When I mouse over this trend line, you can see in the bottom left-hand corner that a box appears, this right here. So the low during this time frame is right here. NVIDIA had a low of $86.62. And within that quarter, actually the 4.5 months, just imagining that they turned this form in at the deadline, it had a high of $184.48. And if we focus on that box that I showed you in the bottom left-hand corner over here, the box disappeared. Okay. It had 112% gain from that low to the high within that 135 days. So by the time you found out about when this person possibly had purchased this stock, it had already made over 112% gain. Now you need to understand the stock market in order to understand why this is a problem. One of the prevailing theories about the stock market is that, one, you can't time it. That I do not believe, because I've seen enough charts in my 7 years of experience of looking at this. There's a big difference from somebody who bought it down here at the low at a certain time and then sold it up here at a certain time, or bought it up there at a certain time. The person that bought it at $184.48 at that time is losing money right now, because the security NVIDIA since Friday is now trading at $180.45. So if somebody has a long position, they just bought those shares when they were $184.48, they are losing money now because the shares are less valuable than they were when they purchased them, versus somebody that purchased them during this time. The prevailing theory is that it's impossible to time the markets. That, in my opinion, is not true. And timing isn't everything, because it's not the only thing, but timing is possible and it's important. So if it's important, you would know that it would have been better for you to find out down here when somebody purchased it versus finding out up here when somebody purchased it. So the other idea is that they tell you if you get a 7 to 10% return, somewhere up in there, maybe even 13, as long as you're with the benchmark of gains with like something like an index or S&P 500, then you're doing great. That's the idea. So you know that based off of the prevailing theory, this shouldn't be sustainable if you should be looking to get a 7 to 13% return. And this particular stock has already made 112% gain within 4.5 months or so. This is why I do not believe that trying to shadow portfolios is effective, because this is how much a security can move by the time you find out about it. So that 7 to 13%, the benchmark, is something in the space of investing tells you that you should get within a year. I forgot to give you the timeline because time frames matter, because you need that variable in order for you to measure an investment. And let me give you an example. If somebody said I made $1,000, like I invested $1,000 and I made $1,000. Oh, that's great. That's a great return. How long did it take? That's an important variable. Like, how long did it take? Oh, it took 20 years. That changes that entirely. It took you 20 years to make $1,000 with $1,000 investment. That's a long time. Now, if they doubled their money in 4 months versus that time frame, now we talking. You see what I'm saying? So if they're saying you supposed to get 7 to 13% in a year and somebody got 112% in 4.5 months, you can see how that's significantly different. And based on what they're saying, this shouldn't be sustainable. It's astronomical. It's an anomaly that this person even achieved 112% return in a 4.5 month period. So that's the idea. So let's get back to these forms. There's a specific schedule for the quarterly deadlines of the Form 13F, which is May 15th, August 14th, November 14th, and February 14th. If they traded on January 1st, the person's whose portfolio you wanted to shadow, and they waited until the deadline of May 15th, you wouldn't find out about those trades until 4.5 months later. If it was a stock they purchased or sold, that company would have had earnings by then. This was one of the things I researched to figure out if key people were having huge success in the markets. Why didn't people just shadow their portfolios? If they were being transparent about their trades and having success, wouldn't you have success too? I think these are the two main reasons people don't do this. One is that most retail traders and investors, the general public, don't know that this is public information. And two, the educated, the professionals, know this information is available, but they understand that the delay is too significant to be effective. So why would platforms show retail participants, a novice, a beginner, a non-professional, what key investors are doing in their portfolios, knowing it wouldn't be helpful to shadow? Because as long as they give you a disclaimer, they're not liable for one. And they know if you don't understand the drawbacks of it, there's a chance you'll use it to make trades and investments, which helps them make money even if you lose. This helps them. So they don't care. They're going to make money anyway. You have to be on the lookout for things like this with brokers. Certain offers and features a broker has tells you a lot about the quality of that broker. A dealership doesn't give you free cars to get you to buy cars. So why would a broker give you free stocks to get you to buy stocks? Guys, sometimes free get you in trouble. And you have got to get out your mind, if you want to be successful, you want to be wealthy, that being successful is going to be free. You got to get rid of this mindset like it's not going to be some type of effort or sacrifice involved. A quality broker has so much to offer in areas where it matters the most. The value sells itself. And if you knew what they were, you wouldn't care about free shares. But I digress. I wanted to share this with you because as soon as I saw that a broker was offering this feature, I knew that someone would ignore the disclaimers the broker had about it, shadow the portfolios anyway, and lose money. Guys, I know that education isn't as attractive or sexy as other things that seem like it's going to get you rich quick. I understand that. But as soon as someone mentions education, you should already know and understand, which is part of the reason why you don't want to do it, that there's more work and time involved than something that's quick and easy. And sometimes you just have to ask yourself this one question. If it was quick and easy and somebody was just giving the information away, why doesn't everybody do it? Easy Street is crowded. It is crowded, guys. That's one of the reasons it's never easy. There's always traffic and somebody's always getting pulled over and locked up. And scammers on every corner getting over on people that believe that something worth having is supposed to be free and or easy. Whether you want to believe it or not doesn't change the fact that it's true. Education is where the money is. And the bill for not paying it with time, work, effort, experience, and money is a lot higher than just paying for it. Success lasts longer when you truly put in the work to earn it, and it feels better. You sleep better at night knowing you didn't cut corners, got somebody after you, or you've got over on somebody. You sleep better. You haven't noticed how someone who cuts corners or gets over on people to be successful, the success usually doesn't last long. And if they do manage to get over on people for a long time, their downfall, when it does happen, is hard, fast, public, and humiliating. Again, education is where the money is. So the book for today is The Intelligent Investor by Benjamin Graham. And I've actually had this book in my library for quite some time now. I'm finally getting around to reading it. And it's starting off as an excellent read. The first edition was published in 1949, and this one is the 5th edition with a preface and appendix by Warren Buffett. And it's updated with commentary by Martin Zweig, a writer who's been writing about investing since 1987. He explains how the principles by Benjamin Graham are timeless and how they can be applied in today's markets. He gives you examples and little footnotes in the book. So if you want to check it out, you can hit your local library. And if you want to purchase it, I'll have the link down in the description. It's an Amazon link. It does help support the channel at no extra cost to you. You already know. I hope that you learned something, and I hope that you earned something. Put your thoughts down in the comments. Let me know what you guys think. And if you want to learn how to navigate and use the features on a position statement in the Think or Swim platform, check out this next video. Take care and God bless.